Welcome to the world of smart investing. Today, we're diving deep into the heart of India's financial hub, the Bombay Stock Exchange, or BSE. Whether you're a beginner or an experienced investor, understanding how to analyze BSE shares can help you make better, wiser, and more confident decisions. In this video, we'll explore everything from how the stock market works to real-life examples of top-performing companies. The Bombay Stock Exchange, or BSE, is India's oldest stock exchange. It's the place where companies list their shares so people like us can buy a small part of their business. When a company grows, the share price goes up, and so does your money. Every day, millions of people talk about the stock market. Prices go up, prices go down. But what really happens behind those flashing numbers? Is it luck? Or is there a method, a story behind every rise and fall? To buy best stocks, you want to know about positive free cash flow, market capitalization, return on equity, zero pledge percentage, and debt-to-equity ratio. Let's see, one by one, positive free cash flow, what it means in the stock market. Do you know what makes a company truly strong, even more than profit? It's called free cash flow, the real money a company keeps after all its expenses. Free cash flow means the money left with the company after paying all its expenses and making new investments. It's the real cash available to give dividends, reduce debt, or grow the business. Free cash flow formula is free cash flow, FCF, equals cash from operations minus capital expenditure. Cash from operations, daily earnings. Capital expenditure, money spent on assets. Let's take a simple example. A company earns 500 crore from its operations and spends 300 crore on new machines. So free cash flow equals 500 minus 300 equals 200 crore. That's positive free cash flow, a very good sign. Now imagine the opposite, negative example. The company earns only 200 crore, but spends 400 crore. Free cash flow equals 200 minus 400 equals negative 200 crore. That's negative free cash flow. The company is spending more than it's earning. You can judge companies easily. If free cash flow is positive, that's good. Negative means risky. Strongly positive means the company is excellent. Let's look at 2025 examples. Let go the Google and click screener, then click screens in that side you will see browsing sector. Now we can click IT services. Then you will see this page here. You can search which company you want. Now let's check about Infosys. The page will appear. Then we can check the cash flow of this company. What is market capitalization? Total value of a company in the stock market. It shows how big the company is in terms of its total share value. Market cap equals current share price into total numbers of shares outstanding. Example: suppose a company has share price equals 750 rupees. Total shares equals 20 crore. Market cap equals 750 times 20 equals 15,000 crore. This means the company's market cap is 15,000 crore. It is a large company, usually called a mid-cap or large cap. When a company's market cap crosses 15,000 crore, it usually means it is a financially strong company with investor trust. The company has stable revenue, brand recognition, and consistent profits. It often falls under large cap stocks, depending on SEBI classification. Large cap companies are less risky but grow slower. Small cap companies grow faster but are more risky. Sales growth, formula, and explanation. Sales growth equals current year sales minus previous year sales, divided by previous year sales, multiplied by 100. Example with screener on. You check Tata Motors on screener on. Year, sales revenue, 2023, 320,000 crore. 2024, 360,000 crore. Now apply the formula. Sales growth equals 360,000 minus 320,000 over 320,000 times 100 equals 12.5%. So, Tata Motors sales grew by 12.5% from 2023 to 2024. How to check this on screener.in. Search Tata Motors. Scroll to Profit and Loss section. You'll see yearly sales, revenue. You can calculate sales growth percentage using the formula above. How to select a company using ROE, return on equity. ROE means return on equity. It shows how much profit a company makes using shareholders' money. Formula. ROE equals net profit divided by shareholders' equity into 100. Example, if profit equals 20,000 and equity equals 100,000, ROE equals 20,000 divided by 100,000 times 100 equals 20%. A higher ROE means the company is using your money efficiently. Look for companies with ROE above 15% for the last 3 to 5 years. Example, Tata Motors ROE approximately 29%. It shows strong profit generation. What is zero pledge percentage in shares? Sometimes company owners called promoters borrow money from banks. To get the loan, they use their company shares as a guarantee. This is called pledging shares. If the company can't repay the loan, the bank can sell those shares and the share price may fall. Now, when we see zero pledge percentage, it means the promoters did not borrow any money using their shares. That's a good sign. It shows the company is not under loan pressure. Let's see how to check the zero pledge companies. Go to Screener and go to Sectors. There you select which you want. For example, let's check about IT services. This page will appear and see the pledged column. It shows the zero for those companies. So, these are zero pledged companies. Example, TCS and Infosys have 0% pledged shares. It means their promoters didn't borrow from the bank using company shares. So these are financially strong and safe companies. But if a company shows high pledge percentage, like 40% or 50%, that means promoters borrowed a lot, which can be risky for investors. In short, zero pledge equals no shares given to bank equals safe company. High pledge equals shares given to bank equals risky company. What is debt-to-equity ratio? The debt-to-equity ratio shows how much a company borrows compared to how much owners have invested. Formula. Debt-to-equity equals total debt divided by shareholders' equity. Example, if a company has 50 crore debt and 100 crore equity, then debt-to-equity equals 50 divided by 100 equals 0.5. That means for every 1 rupee of owner's money, the company borrowed 50 paise. What it means, low ratio, less than 1. Company uses less debt, safer. High ratio, greater than 2. Company depends too much on loans, risky. Low debt to equity equals safe company. High debt to equity equal risky company. So by seeing this video, you can analyze how to buy the best stocks.